Good morning.
Good morning, James.
Let's just make sure we've got Q&A turned on and everything so we can see what we're doing. Good, thank you very much for doing this. I'm quite interested to hear how the thing's been going since it was launched. I think you've got a presentation, so maybe if I just let you introduce the fund first and just what it's trying to do and how you're going about it, please, that would be quite helpful, please.
Yeah, of course. So thanks very much for the opportunity, and hello to everybody who's watching. So the Social Impact Trust was launched December 2020, and it's targeting investments that make a significant contribution to tackling UK social challenges, and investments that offer high quality returns to investors alongside transformational impact in the UK. The trust offers access to high impact investments in private markets, and that's often where the best opportunities lie in this sector. It invests across three main asset classes: high impact social housing, debt for social enterprises, and social outcome contracts. And we can talk a little bit more about what they are perhaps a little later. The trust includes co-investments, secondary deals, and closed funds that are only really available through the trust, and as a result of the manager, Big Society Capital's network of fund management partners and long-standing in the sector. What's common to all of these asset classes is that they provide high exposure to stable government source revenues. They also offer resilience to inflation and crucially low correlation to mainstream public markets. The trust has delivered a 6.9% annualized return since inception to the end of last December. And as of our interim report at the end of March, was continuing to deliver in line with plan, and our target return of CPI plus 2% over the cycle, and once fully invested. And we'll publish our next portfolio update at the end of this month. I thought it'd be useful, James, if we turn to the next slide, to just provide a little bit of context in terms of what we mean when we talk about high impact. And we tend to think about impact in terms of investor intentionality, and we use a simple ABC framework. So investors, when they think about impact, can first of all avoid harm, screen out companies that they think are causing harm to society and the planet. They can focus in on companies that are benefiting people on the planet. And they can also, if they choose, go a step further and contribute to solutions. And that's very much where the trust is focused. And the A and B of this chart is typically what would be thought of as ESG investing. And of course, more typically just good investing these days. So the trust is very much focused at the highest level of impact intentionality. So James, if we flick to the next chart, how big is the opportunity? Well, to give you a flavor, right now in the United Kingdom, there are 270,000 plus homeless people, and the investment required to provide housing for those people is 13 billion pounds. In addition to that, we have about 1.5 million older people who are not receiving adequate care and support, and to bridge that gap would cost roughly 7.7 billion pounds annually, and that number's growing. And obviously, with the huge rise we've seen in energy prices, we are facing a crisis really in terms of energy affordability. And we estimate that this year there'll be around a third of UK households at risk of fuel poverty, and the amount of money to properly insulate UK housing stock is huge, 65 billion pounds. So these are huge levels of investment that are required. Government alone isn't able to provide the money to do this. Private capital is needed to do this, and we think that that's very much where the opportunity lies for investors who are targeting impact and providing considerable value to government and society as a whole. So if you flick to the next chart, the trust, as I say, was listed in December 2020. We did a second fundraise last autumn, and right now NAV is around 90 million pounds. We're pretty much fully committed at this point. We're already financing around 160 organizations. Those organizations that we're financing have provided benefit in terms of housing and other services to 160,000 people, with at least 90% of those people falling into a category of disadvantaged and vulnerable. Those organizations that we're supporting have delivered 10,000 affordable homes, and crucially, the savings for households and for the government as a whole of those organizations' work is nearly 56 million pounds. We talk a lot about impact as a source of value, and it's those savings and the small proportion of those savings that get recycled to private investors that we think really illustrates, you know, the huge value that that focusing on impact and some of these deep-rooted social issues can provide. So if you just flick to the next chart, James. Yeah, we can talk in a lot more detail. Actually, I think I'll probably stop there, James, if that's okay. And yeah, we can maybe dig into some of the more detailed aspects of these asset classes and the sort of return profile there. But that's fundamentally what the trust is offering in a nutshell.
Okay, great. So actually, can you tell us a little bit about Big Society Capital and how you ended up getting together with Schroder to launch the fund in the first place?
Yeah, absolutely. So Big Society Capital was launched in 2012. It's our 10th anniversary this year. We're a private company, and we were set up to take delivery of 400 million of dormant assets that were taken out of the banking sector back in 2012. So 400 million was injected into the company. Another 200 million came from our major shareholders, which are the high street banks. And the mission for Big Society Capital was really to seed and to grow the social impact market in the UK. So over the last 10 years, we have deployed around 850 million pounds into social impact investing. And alongside other investors, we have delivered 2.5 billion of social investment. So we are, you know, totally specialized in this area of the market. 30 plus investment professionals whose only focus is social impact investing in the UK. So we partnered with Schroders. Obviously, Schroders bring huge expertise in private assets, tremendous depth and breadth of knowledge in sustainable investment, and of course, first-rate skills in investment trusts, in all aspects of investment trusts. So you know, it was a natural partnership for both organisations, really, in terms of this product.
And having that investment trust structure, sort of closed-end fund, was that important too?
Yeah, absolutely. So I mean, as I said up front, you know, the most interesting opportunities in high impact social investing are private assets. You know, and obviously what comes with many private asset funds is a great deal of complexity, huge amount of complexity in terms of originating deals. You know, significant requirements in terms of due diligence, deal structuring, and then obviously the management of a portfolio of private assets. All of that really meant that this was a market that was only really open to large institutional investors. So the investment trust wrapper, if you like, around this portfolio of assets was to us the obvious solution to bring these investments to a much broader market.
Are there any listed things that you could buy?
I'm sorry, James, I missed that.
So are there any listed investments that you could buy?
Yeah, so we have mainly as a liquidity management tool, because obviously the drawdown on some of these private assets can be 2 to 3 years, but mainly as a liquidity management tool, we invest in something we call liquid ESG, and this will include a number of listed vehicles. So, for example, we currently hold in the portfolio Greencoat wind and Bluefield solar. And the purpose of these investments, as I say, is to manage liquidity, to minimize cash drag whilst the private assets are deploying, and obviously to provide a degree of return to the portfolio. So it's not core to our strategy. The core to our strategy is very much those hard to reach private assets, but as a liquidity management tool, we will invest in some liquid investments that fit our criteria in terms of sustainability and the broad risk characteristics that we're looking for in the trust. So
when you make these investments, I mean, like we were talking about private equity earlier, and then the end game there is you'll do whatever you want to do with the company, and then you'll IPO it, or you'll sell it on to another private equity player, or something like that. So there's like an exit, if you like. What's the sort of end game with these impact investments?
Yeah, so most of these investments will be held to maturity. So the trust is an investor and partners with other specialist fund managers, as well as doing its own co-investments and other secondary deals. And yeah, the exit very much there is that the portfolio will be deployed. Over time, those investments will be realized, primarily as I say, as a result of being held to maturity, and we will reinvest the cash as those distributions occur. Obviously, as you can imagine, the scope for these investments to exit as a result of sale to third parties or market listings is pretty limited.
Yeah. Okay. Fair enough. So we've got the three core impact asset classes there. What's the sort of breakdown between the three within the portfolio?
Yeah, so as of the last set of results, which were the end of March, in terms of committed capital, we had 40% in high impact housing, 51% in debt for social enterprises, although it's important to point out that within that there is a portion of equity and equity-like exposure, and 9% in the social outcome contracts. And they're sort of broadly within the ranges that we're expecting for the portfolio over time. Okay,
cool. And I suppose debt we can all get our heads around. That sort of makes sense. And housing is, I suppose, very much like what Civitas and Triple Point are doing. Is that true? And I suppose Home REIT.
Broadly the same market, although we think our approach is differentiated. As really an impact-led investor, we focus very much on partnering with organizations that have long track records, strong balance sheets, and crucially, excellent credentials in terms of the delivery of impact. And we've included an example later on, which we can go through if there's time, of some of the types of organizations we work. So the social and affordable housing market is very broad. You've mentioned those other listed vehicles. There are many different ways to approach this market. We have, with the trust, focused very much on the high impact end of that, and ensuring that we work with the highest possible counterparties.
Okay, and then the social outcome contracts, they're obviously something a bit different. So maybe if you give us an example, can you just explain how they work, please?
Yeah, absolutely. So, in many respects, social outcome contracts are the kind of ultimate uncorrelated asset. So typically what happens is a commissioning organization, often a local council, will have identified a social problem that they are looking to tackle. I mean, one of the examples we use quite a lot is in West London. So obviously an area of immense wealth, but also huge deprivation. And an organisation there called West London Zone was established, and the local councils in West London put together a contract with a consortium of charities to deliver support to young people who were struggling with their education in West London. And so the way that the contract is structured is that the consortium will sign up to deliver certain pre-agreed outcomes over the course of that contract, typically 3 to 5 years, and they will get paid out on the basis of those outcomes as they're delivered. So the role for private investment here is to really provide the working capital for those organizations between the point of the contract being awarded and the delivery of those outcomes and payout. So it's a very innovative way of providing social services. Big Society Capital actually just released a report, which was widely reported in the press and actually quoted in the House of Commons, that for every £1 invested in social outcome contracts, around £10 of value accrues to the government and society as a whole. Of that £10, the savings to government as a result of more efficient delivery of social services is roughly £3. So, we think this is a pretty compelling way of delivering social services, and is quite a good way of tackling some of the more complex issues that we have. So there are outcome contracts, mentioned West London Zone. There are outcome contracts for families with children on the edge of care. There are outcome contracts for refugee support, and a whole range of other issues. But the crucial point here is that you get paid out on the basis of those outcomes.
Okay. Inflation is obviously playing on everybody's mind at the moment. And you've got a couple of sectors there that you just say have got some inflation linkage. Obviously, I think you're trying to target as well inflation plus a figure in terms of the returns over the cycle. How do you think you're going to cope in terms of delivering on that ambition with inflation where it is?
Yeah, absolutely. So I mean, we've been thinking about higher inflation for a while, and the portfolio has been very much put together with that in mind. And obviously, as you mentioned, it's a CPI plus target over the cycle once fully invested. And I think they're very important caveats. The relationship between the various parts of the portfolio and inflation is relatively complex. There are certain lag times in terms of adjustment to inflation, but what we've said to investors in order to explain how this works is just under 2/3 of the portfolio will benefit from higher rates of inflation. So within the portfolio, we have index-linked leases on some of the housing contracts. We have ownership of real assets, so there is ownership of housing and renewable assets, and we are lending to social enterprises that also have government-linked contracts. The other thing we've done with the portion of the portfolio that isn't going to benefit from inflation is we've managed the duration of the debt. So we've tried to keep the duration of the debt component of the portfolio as short as we can. So obviously, as that refinances, there'll be a benefit from higher interest rates. So the relationship is complex. We do not market this portfolio as an inflation-linked portfolio. We say it's inflation resilient. But as of the last interims, we reiterated the target of CPI plus 2% over the cycle once fully invested.
So yeah, I think you said you're more or less fully invested now. So is the clock starting to tick in terms of the beginning of the cycle so that we can see how well you're doing?
Yeah, absolutely. So we delivered last year, as we said, 6.9%. That was an annualized number from the early December 2020 to the end of December 21. So fully committed at this point, 80% deployed. So there's still a little bit of room for further drawdown of investments. Obviously, given where inflation numbers are this year, I think it's going to be challenging for anybody who isn't directly RPI linked to deliver that inflation plus return. But we are, we're reiterating that over the cycle, we will deliver the CPI plus 2% target.
Okay, cool. So I mean, now that you're sort of fully committed, is it time to be looking for more money?
We have an ambition to grow the trust. I mean, at the moment, it's 90 million. We certainly have the pipeline to be able to grow the trust, and the trust is trading at a small premium at this point. It's a new and pioneering product in the UK market. So we are in the process, I think, of explaining and bringing this product to new groups of investors, and that does take some time. But absolutely, James, we would love to grow the trust. We certainly have the pipeline to be able to do that, and as and when market conditions allow it, we would certainly like to come to investors and test demand.
There's an interesting question here. How much of the need for this trust is related to which government's in power? So obviously, if you had a government that was prepared to spend more on these sorts of areas itself, would perhaps your role wouldn't be quite so necessary. Do you agree with that?
It's a really, really interesting question. And BSC as an organization, we've always considered ourselves trilingual. So we have, a strong relationship with government, strong relationship with the social enterprise sector, and obviously, crucially, we are investors first and foremost. What we've done with everything that we do at BSC, and particularly in this portfolio, is focus on issues that we think are both huge in terms of the capital needs. So to answer directly your question, we don't think that even the highest spending government is going to be able to find the capital to address these problems on its own. It will always need private capital. But we've also targeted social issues that typically have cross-party support. Whatever complexion of government, we believe that there will always be a need to deliver these services. And as I say, if we can stay true to that idea of impact as a source of value, if we can generate savings for government and prove those savings, if we can generate savings for broader society, then we think that this type of solution for UK social problems, it stands on its own, if you like. We see a huge opportunity here. We don't think that that's reliant on the complexion of government. We've seen support for these issues across party over time, and the needs are huge. So we are obviously very attuned to government policy and government risk, but we've very much structured the portfolio to take account of that.
Okay, cool. How do the fees work? Because obviously you've got a team of people managing this and they need paying. Yes. How does it all put together?
Yeah, so the fees, the headline fees on the portfolio are 80 basis points, but we only charge fees on the high impact portion of the portfolio. So the liquidity management portion, the liquid ESG that I mentioned, we do not charge fees on. Our view very much is that this is a vehicle to allow access to those high impact private market investments, and investors should not be paying for investments that they're able to access on their own. So it's 80 basis points fees, in addition to that, obviously there's the costs of running the trust, which as we grow should fall as a proportion of the total. But that's broadly the fee structure at the moment, James.
Is there a performance fee?
No, there isn't.
Okay, cool. I think these are unusual investments, and I suppose they come with sort of unusual kind of risks. How do you actually manage the risk exposure across the portfolio?
Well, the risk exposure comes on a number of different levels. I mean, at the portfolio level, we are well diversified. So those three different asset classes have different characteristics and are targeting different parts of the market. So there's that overall asset diversification benefit. Within each of these asset classes, there's also a range of different investments. So there's diversification across asset classes and within asset classes as well. We also think about risk in terms of business risk. So as I said, a large proportion of the revenues of the underlying organizations are government related. At the moment, that's around 80% of the portfolio has government related revenues. And then there's that other aspect, of course, that we mentioned, which is the inflation resilience. So, on various different levels, we're thinking about risk. We're trying to produce a portfolio that has broad diversification benefits within the portfolio, and also that behaves very differently to many of the other investments in investors' portfolios. So we think there's a diversification benefit from holding the portfolio, and we're starting to see evidence of that in the performance of the shares year to date. Been very, very stable, slightly up actually through all of the market turmoil. And we think that this is a growing appreciation that this is a portfolio of assets that should behave very, very differently to mainstream markets.
Do you have any competition, do you think?
You mentioned the housing REITs, and that's a comparison that's made quite a lot. We think that what we're doing is quite different to those housing REITs. And also, we think what is of course very, very different is that we're diversified across different asset classes. So when you look at the UK market, certainly in the listed market, we think that what we're doing is pretty unique. We think social impact will grow. We think there will be other social impact trusts probably coming to the market over the longer term. We think that this is a sector that will continue to grow, much in the same way as we've seen the environment impact sector grow over the last few years. We think that social has as much opportunity for growth in the longer term.
Great. One last question then, which it's like perennially we get. So is this something that you actually back with your own money as well? Are you invested in the fund?
I'm actually not allowed to, which I think is a real shame. I mean, obviously, given the nature of these assets, there is a risk that as an organisation we have inside information on the movement of these assets for very long periods of the year. So as things stand, we're not allowed. But I do think it's a great investment. I mean, I would own it myself if I could. And I think, yes, I'll probably leave it at that, James.
Actually, we didn't talk about this, that you put this example in here. Actually, we've got a couple of minutes. Do you want to talk about the Hull Women's Network and how that? Yeah,
I'd love to. I mean, this is a great example of how the social housing investments work. So Hull Women's Network is an organisation that's obviously working up in Hull, one of the country's areas of highest deprivation. The statistics in terms of domestic violence in Hull are really quite shocking. 66,000 women and families exposed to domestic violence in that region alone every year. The issue here and the social problem that was really looking to address with this investment is that in many cases, victims of domestic abuse are forced to return to their abusers because they don't have somewhere to stay. Hull Women's Network provides transitional housing for those families to escape domestic violence, also a whole series of wraparound services as well. And because this is a property-based investment, we think it's absolutely well suited for our combined mission of generating returns and social impact. So the partner for us on this investment is an organization called Social and Sustainable Capital. They established a fund. The trust has invested in that fund, and what the fund does is provide financing for Whole Women's Network to buy more houses for those families fleeing domestic abuse. They're buying ordinary houses on ordinary streets, so there's very, very strong alternative use value, something that we look for a lot in our investments. And the investment participates both in rental payments. So the families that are in these homes are recipients of housing and benefit. So there's an interest payment that's made on the back of that, but there's also participation in the value of the home. So it's another one of those sort of real assets, and again, quite a strong characteristic of the investment, we think. So the capital has gone there to allow Whole Women's Network to buy more homes to help more victims of abuse. It fits the thesis perfectly as well, in the sense that domestic abuse is a massive issue in the United Kingdom, and estimates suggest that the cost to government of domestic abuse is £66 billion a year. So there's an immediate saving to government, because often these families are moving from bed and breakfasts or other emergency housing. So there's an immediate saving in terms of turning that payment from a high payment for a bed and breakfast into a housing allowance, but actually the benefits are much broader than that. And so again, illustration of this investment thesis: impact as a source of value, savings for government, savings for society overall, a sustainable and high quality return for investors, and of course support for those families in crisis.
Great, thank you very much for that, Andrew. Right, we'll follow the performance of the fund, I think, with interest. And if you do raise some money, please give us a shout, and we'll see what we can do to publicise that. We'll be back next week talking to the manager of GCP Asset-Backed Income. We do have somebody, I think, lined up for the 15th, but I think we can't quite ink it in yet. But we will let you know next week who that is. And we'll be running these things all the way through July. Andrew's going to come and talk about July a week early, because he's off on holiday, I think. Fair enough. We'll all be coming and going over the next few weeks. So do have a good week, and we'll see you next time. Thanks very much. Goodbye.